Aha! Now then, fancy seeing you here. Come here often. Thank you for sticking with us. It's been an eclectic morning, and into this afternoon we are going to finish off today's advice show with a session all about the defined benefit pensions market. As I mentioned earlier, a day doesn't go by without something hitting the headlines in this area. Most advisors that I bump into across the country at events will tell you that there is just an increasing and surging demand there. So we've pulled together a crack team to lift the lid on everything that's happening out there. And the wise men that I've pulled around are in no particular order of how wise they are. We've got Steve Cameron, who's the Public Affairs Director at CoFunds. Mark Wilson's the Managing Director at Pension Help. And we've got our very own Andrew Thulis, who's the Pensions Technical Advisor within the SimplyBiz Group. Gents, what's the latest things that advisors really need to be keeping their finger on the pulse of around this market? We've had seemingly unstoppable consumer demand raging around, and then the regulator's recent consultation. What are the opportunities, but what are the things that should be raising a flag of caution? Andrew, do you want to start us off?
Well, obviously the most important thing from our point of view, the queries that we're getting on a daily basis, are the consultation paper, latest consultation paper, CP 1716. So anybody that's involved in the defined benefit transfer market and advising that area should be fully aware of the contents of that report and keeping a close eye on the compliance and technical times bulletins going out from our policy team. So that's a good start point, I think.
Okay, good plug. Mark, what do you think? You're obviously at the sharp end of providing transfers in this marketplace.
Sure. I mean, agree with Andy to a large extent. A big aspect of what we're doing at the moment is policed by, to a certain extent, the consultation paper. Quite a few advisors are finding themselves in limbo a little bit at the moment. Consultation period's closed. Early 2018 we should have some sort of statements in relation to the consultation period, but it's brought a lot of issues to the table. I mean, I think the consultation paper's long overdue. The changes to flexibility were announced in 2014. 3 years down the line and probably about 200,000 transfers later from DB schemes, we've got this paper. I think it is a step in the right direction for people. I think it's going to bring a better framework for advice and give people a bit more confidence to give advice. And it's also moving it into the more modern environment, really, bringing flexibility into the equation of the analysis. So certainly a step in the right direction on the consultation paper, and I think that's the key area at the moment on DB reviews, really.
Steve, are the regulator getting this right, do you think? Are they heading in the right direction?
Well, I think they are. We've been lobbying the regulator for about the last year, asking them to stop focusing on the past and start focusing on the future, and to really try to help advisors have some confidence that they understand what the regulatory expectations are and what good looks like, to the extent that the FCA will ever tell us what good looks like. And I think that the really important things are to create that regulatory clarity, to give advisors more confidence that they know what's expected of them, and therefore we've got this huge demand for advice and the supply is much below the demand, so we need to get a market that works, that's delivering what customers are looking for. And I also agree that pension freedoms have completely changed the marketplace. People, I don't think, are now looking to transfer out of DB schemes because they think they can buy an annuity that will give them a higher pension than their defined benefit scheme. They're transferring for a wide range of reasons, a lot of them linked to the pension freedoms. So yeah, I definitely think they're heading in the right direction.
Do you think, do any of you share Ken Davies' concerns about the pensions freedom impacts in this market and people taking significant defined benefit schemes and then not essentially utilising it correctly for what is an unknown retirement?
I can pick up on that one. I think that there are two types of situations. There are people who seek advice and go into the pension freedoms having fully understood what these mean for them. And there are others who might take out a drawdown contract without having sought advice. And I think it's the second group where the primary concerns lie. And that's where the FCA certainly seem to be focusing in the retirement outcomes review. So I think that's where the focus is. But the government decided that people should have freedoms, and now we need to make sure that they use these freedoms in the best possible way, and that absolutely involves advice.
Okay. What do you think, Andrew?
Yeah, I think that message comes through in the consultation paper. It's making sure people make informed decisions and understand the value of what they're giving up as well as of what they're going to gain in the new environment. And I think that comes through with the new transfer value comparator. Because people tend to, you'll see this commentary in the press quite a lot about behavioural biases and understanding a lump sum now rather than a stream of income in the future. And I think that's what's driven the transfer value comparator, the capitalised value with death benefits, and that analysis being required as well in the new environment, if it comes in the form it's proposed. So I think that's a good thing. I agree with Steve.
Do you expect the supply of advice to increase on this, or do you think that more and more it will be a very specialist approach?
It's a good question. The very brief answer to that is I don't think anyone's got any idea really. The longer answer is really, it's a very specific part of the consultation paper that the FCA are looking to widen the supply of advice really, and it will be a measure of its success whether the supply does widen. If people are still too afraid to go into the market of giving advice, then quite a big chunk of the consultation paper has failed really. I think given the new way that the comparators are going to work and bringing in the different factors that need to be considered on transfer, I think it does provide that framework really where people might have a bit more confidence to go into the market and say, well actually I have reviewed these elements that the FCA have said. They probably will give, they're not going to be too clear about it, but give some indication of what good looks like. And I think that'll give advisors more confidence to go into the market. So I think it will widen the supply, but other elements will come into play on that, whether PI see it in the same way and whether people can get that, and whether people are still haunted by past events really in the DB market and think, well, I don't want to take that risk and not go in. So it's unclear, but I think if the framework is clear, that people will have a bit more confidence to go into the market and say, right, I'm confident that I can give this advice and not move from a safe area in providing advice.
If you could wave a policy wand, Steve, to help increase the supply of advice here, what would it be? What's the key things they've got to get right?
Yeah. Well, I think it is the clarity. We, Co-Funds Aegon, did some advisors research. We produced an advisor attitude survey, so that's my little plug. And we asked advisors where they saw the demand for advice coming from, where they saw the growth opportunities within their business. And by far the most popular answer was DB to DC transfers. So over half of advisors that we surveyed said we expect to see increasing demand for this service. We expect to be doing more of this going forward, subject to getting that regulatory clarity. So that's the regulator's focus. Make it clear, remove that fear factor, allow those advisors who've been on the cusp to decide to enter this market. You mentioned PII, and I think that this may be wishful thinking, but I hear that some of the PI premiums where you advise on DB to DC transfers can be quite prohibitive. So why are they charging more? I think they're charging more because there is this lack of clarity as to what the regulator might say about advice in future. So if we get that clarity in place, there should be less fear that there might be unknown claims against a firm in future. So why have those increased PI premiums? So what I'd like to see is the PI insurers also reflecting on that clarity and reducing their premiums, and I have suggested in our response to the consultation that might be something that the FCA might pick up on separately and go and look at that part of the market to see if it is responding to their clarity.
Yeah, so I guess if you've got the supply of advice on the one hand, you've the consumer demand on the other. Do you see any change, or is this just going to be an inexorable increase in terms of the demand for this?
I'd take that. The demand at the moment is coming from several factors that are involved. First one is the introduction of flexibility, so people are seeing the benefit of moving where perhaps historically they wouldn't have even considered moving. I think the FCA have recognised that element as well. So with flexibility being new, we've got a surge in demand in that respect. And also coupled with that, we've got relatively high transfer values. We're looking at transfer values that in some instances we've never seen at that level before. So we've got these two forces pushing demand up. Now, I think most people would expect transfer values to remain at relatively high levels for a period of time, but going further forward, we would expect that to tail off in due course. And also the people who've been attracted by the flexibility might have already moved. So again, that the force for people looking for flexibility may drop off. So you may get to a more normalised state there where people are, you know, looking at transfer values, perhaps when they get to retirement or perhaps when they leave a job. And I think that'll possibly be the more normal state of demand. You might also see employers taking a bit more of a interest in the staff, really. I mean, going back in time, really, there's your pension with PCLS. Which one do you want? You might see more and more employers saying, here's your transfer value as well. And it being a very normal way of looking at taking retirement that you consider your transfer value, a bit like with a money purchase pension. There's your pot, there's the annuity. Take advice. So I think demand will probably stay at quite high levels for a period of time, then drop off and return to a normalised state. The other factor that may come in is if transfer values start to fall, you may see quite a surge there where people are thinking, I will move now rather than risk the transfer value falling.
Okay.
Another factor, just if I can pick up on this, is we've obviously had the BHS, so if Philip Green has done nothing else for pensions, he's encouraged people to think about the security of their DB pension. And I think the headlines yesterday, in fact, that made front page of the Daily Express, was that 3 million people have only a 50% chance of receiving their full pension from their defined benefit pension. I think when the PLSA come up with their super trust idea, they weren't aiming to boost demand for transfer advice, but I think when people read that, they will immediately think, oh my goodness, is my defined benefit pension safe? And that will be another reason which will stoke demand for these transfers.
Interesting. What sort of losses of protection, if any, should advisors be really concerned about when they're looking at the transfers?
Yeah, I mean the obvious ones, and they're infrequent, but we come across them, is protected, if someone's got protected cash at A-Day in the scheme. Quite unusual in a DB scheme actually, but it would be lost on transfer if it's not a block transfer. And likewise, if they've got a protected minimum pension age, we've seen a couple of those in recent weeks. So that's where somebody had a minimum age from 50 onwards at 6th of April, 6 A-Day, that haven't been written in the scheme rules in December 2003. Less obvious ones, enhanced protection, you have to be careful because a transfer from a DB to another money purchase arrangement, there is a test for relevant benefit accrual, so make sure that's been done.
So let me stop you there, the relevant benefit accrual, explain that one for me.
Basically, it's a limit on the increase in the rights that were registered at A-Day, and it's a measure, quite a complex calculation, but it can occur on a transfer, so you need to check that. And finally, fixed protections as well. Normally, somebody with fixed protection would not lose those protections on a transfer from a DB to another money purchase arrangement, but there is a proviso that the sums and assets that are received in the other money purchase arrangement are actuarially equivalent to the benefits that you've given up in the DB scheme. So if it's some sort of enhanced transfer value exercise, it's always best to check that out.
Right, okay, interesting. What about this notion of partial transfers? Are we supporting it, and have we seen much of it happening around in the market?
Certainly Aegon supports it, and we have been supporting it for quite some time. I think that the way that we look at it is that if you're in a defined benefit scheme, you've got a secure income, but you've got no flexibility. And if you move over to defined contribution, you've got ultimate flexibility, but arguably no security unless you use a drawdown with guarantees product or something like that. So the idea of being able to have, I think most clients would like a bit of both, and that's where partial DB transfers would play a role. And we know that some schemes do offer this, but equally we understand that there are complexities. So I would love to see the pensions regulator helping trustees work through how to do this in a simpler way. I'm not holding my breath for that. One way that you could get close to this is that many clients will have more than one previous defined benefit entitlement with more than one scheme. So it is possible, of course, to transfer one or more and leave one or more as DB. And advisors are clearly in an ideal position to assess if that works for that client, which benefits to transfer and which to leave behind. So that might be the closest you can get to partial DB transfers at the moment.
Right, okay, interesting.
I mean, it is something that is coming more and more to the fore, the split transfer, partial transfer. I think people are referring to it as an ideal solution. And it does, I mean, in line with the consultation, there's elements of meeting clients' needs, and you could actually look at the part of the final salary DB pension meeting clients' needs and the excess hitting the objectives. I don't really think anyone could be against split transfers in principle. In practice, I think that it caused quite a lot of issues, though. Certainly in some of the respects on the administration behind the schemes, just in respect to the deadline that you've got. A lot of cases when you're assessing them, clients can hold on to pension papers for a couple of weeks, particularly if you're advising from introducer as well, another couple of weeks can be added onto the time scale. We frequently have to write to schemes and ask for fairly basic things, commutation factors, revaluation rates. It can take weeks for them to send something that's actually sat on the desk. So I think it'll be quite a challenge in some respects to get details of a split transfer value. And we're finding as well with clients, sometimes if you say, right, well, I'm looking at doing a split on that basis, when they get the figures, particularly when the transfer values are quite generous, they're saying, actually, I'll give up another £500 income there because that's going to give me £20,000 lump sum, you know. So, you know, in the event, the split transfer doesn't seem relevant. So you do get a lot of that. And there are also solutions that you can use on the open market. In any case, you could transfer and use annuities, for example, for their needs. So there's elements that you can do anyway, but I think in answer to your question, in principle, I don't think anyone can be against the concept of a split transfer.
Yeah, I'll just say as well, I mean, we absolutely agree with that as well. You know, many client scenarios, it would be the ideal solution if you can get to that, you know, underpin your essential expenditure requirements in retirement and then flexibility on top. We do see schemes offering it, some of the large schemes, but as Mark said, sometimes it's not on the transfer paperwork, you've got to ask the question. But they are out there, and I think the hate to say Royal London and Lane Clark Peacock estimate about 1 in 6 schemes do offer a partial transfer of some type now, so always worth exploring.
Okay. Excuse me, can you put that tea down and that sandwich down that you're stuffing and get your typing fingers out? I can't believe that you haven't got a load of pertinent questions that you want to put to these guys on what is the single biggest demand area in financial advice at the moment. So enough of the foot-long subway and more of the typing questions, please. Gents, the size of a transfer pot. What's the what are we seeing out in the marketplace? If there's a transfer value below 30,000, is this going to be advised on or not?
It's a tricky one on the transfer values below 30,000 because people don't actually have to take advice with that. If they do take advice, it's got to come from a pension transfer specialist. Now, in reality, where people don't have to take advice, there's a lot of receiving schemes that are very reluctant to take the money, so that they do need to take advice, and it can be prohibitive. The charges involved in providing advice. It might look okay on paper, but once you've taken a financial advisor's charge out of it, it does take out the suitability of transfer. But again, it's all down to client circumstances. We are seeing quite a lot of what we'd class as relatively modest transfer values from very asset rich people who've maybe done 1-2 years in a scheme, and it's just a very small part of it. So there's elements of that, and even people on means tested benefits might have something like that where the actual pension they would lose on a pound for pound basis almost, so it still makes sense for them to do it. So it's tough to give advice on those, but if they do seek advice, it's got to be given by a pension transfer specialist, and sometimes it's relevant to do it.
Okay. Mark Davis has been in touch. Well done, Mark. He wants to know if the 20 times valuation for DB schemes that you're seeing out there is presently too low. Do we expect to see that increase?
Nothing on the agenda as far as I'm aware. I mean, there are schemes technically you could have a valuation factor greater than that. Historically, if they've got escalation rates above 5, caps at 6, you do see higher, but it's rare. But there's nothing on the agenda as far as I can tell.
Yeah, I think Mark might be referring there to the lifetime allowance calculation. Now, going back when transfer values were a lot lower, you might have 18, 19 times for the transfer value. You actually got a better calculation against the lifetime allowance if you transferred, or a lower calculation against the lifetime allowance. Now, where we're seeing transfer values 30, 40 times even, the transfers generate a huge lifetime allowance charge, or a potential huge lifetime allowance charge. Now, it is possible through manipulation of the income and paying maybe the tax and taking the excess as an income, not to pay the 55% tax charge. So you can manipulate it that way. But I've seen no impetus for increasing the calculation against the lifetime allowance of more than 20. I think it's possibly more likely that if tax relief is taken out on contributions, if it squeeze what's going in, there could be a real relaxation of the lifetime allowance, really. So they'll squeeze what goes in with tax relief and cut the tax at the top end. But I mean, that's speculation, but I think that's more likely than a change in the 20 times.
Okay. I've got an anonymous question come through here, a slightly obscure one. Is the pension protection fund underwritten by the government?
No.
No, it's not underwritten by the government. I mean, the correct definition is, it's a statutory fund established and run by the board of the PPF, which is a statutory corporation set up by the Pensions Act 2004. That's the correct terminology. But it's funded by levies on eligible schemes and obviously all the assets and property and rights of the schemes that enter the fund after going through the relevant assessment period. But again, anybody that's involved in this market, I would say to them, go onto the Pension Protection Fund website itself, read the latest report on accounts, read the long-term funding strategy statement. Currently, I think they're running at 122% on a solvency margin, and even with contingent liabilities accounted for, it's still in surplus. But essential reading, there's all sorts of modelling in there as well as to long-term viability and solvency position. It's aiming to become self-sufficient, I think, on a 2030 horizon, so it's not as reliant on the levies. Do you think
it's set up to take more BHS issues, or?
Well, I think you'll find that the contingent liabilities of, for example, British Steel are accounted for already on a contingent basis. That's my understanding anyway. So, but there's all sorts of modelling on there, as I say, looking at what would happen if a large employer, contagion risks, you went insolvent.
Okay.
It's worth reading.
Right. When we had earlier on in the day, we have our investment session and we're looking at the markets. I asked the fund managers to whip their crystal balls out onto the table and tell us what they think the future holds. So I'm going to ask the same of you, gents. What do you think the biggest changes going to be proposed under the consultation paper will end up being?
Under this consultation,
yeah.
The DB one? To me, the biggest change is that the regulator will be clarifying how to cope with the pension freedoms. Now, it may be that some advice processes already are very good at that. So for some, the change might be incremental and just might be one more of clarifying what some advisors will already be doing as best practice. But for others, having this clarity from the regulator about how do you take into account the pension freedoms world, I think that's a big change in the way that they might approach advising in this field and therefore their willingness to do so. Okay,
I'm going to gaze into your crystal balls in a moment, but before that, Janice Russell has been in touch. Well done, Janice. Not relation, but you never know. Would a hybrid solution be to ask DB trustees to split the transfer value payment? Because at present, a transfer will only be paid to one source. Do you think there's going to be any value in being able to pay out to more than one source?
In respect, I'm not entirely sure what's meant.
I think she's meaning part to provide a secured income and part to another arrangement.
Yeah, I mean, it's difficult to do that in one tranche from a scheme because they will, by and large, only make one payment. You could actually move it to a scheme that does allow a subsequent transfer and do that. So it's something that you can do in any case.
Okay. Richard Jones has been in touch. They're coming thick and fast now. We've woken them all up. Well done. Lunchtime must be over. What's your thoughts on the use of the 7 to 7.5% critical yield threshold as a measure? And is it still relevant?
Well, there is no threshold critical yield. The critical yield is a guide, but there's no set parameters on critical yield. It's a question of looking at the client's circumstances in the round, and again, that's been reinforced by this consultation paper. It gives you a good proxy and a good indication from a financial point of view, but at the end of the day, it's advice related to the client's specific circumstances. You could have the same yield for clients in two totally different situations. One may be suitable, one not. Don't know if Mark could agree with that, but...
Yeah, very much so. I mean, I think for a number of years now, the FCA have been quite clear that the critical yield should not be the be-all and end-all. They've been very critical of red, amber, green type critical yields. I mean, that was clear from the analysis of the enhanced transfer value advice, where that really, in a lot of senses, was the only measure being given. Now, advisors might have set some limits as to where they'd go, and I think 7.5% is banded around quite a bit as a top level where you can recommend transfers. Sometimes that's driven from the PI, who say you're not to do anything over that, so that's where it comes from. But really, for sort of balanced advice, you should be looking away from the critical yield. The consultation paper does bring that into a large extent, so the appropriate transfer value analysis will bring in other elements, cash flow, needs, objectives, all that sort of thing. The worrying thing about the consultation really is the transfer value comparison, really, which does look very similar to the critical yield to a certain extent. Also, a lot of the consultation is referring to appropriateness of the transfer, whereas that kind of takes out the appropriateness of transfer. So things like the pension commencement lump sums taken out of the equation, ill health taken out of the equation. So I'm not sure how that'll play out really, and how much emphasis is given on that. So it's a bit disappointing, but there might be something very similar still after the consultation period. So we'll have to see how that plays out. But really, I don't think any advice model really should have a definition really of you can't go over that critical yield, unless perhaps the client just comes in and says, I want to see if I can beat the exact scheme pension on a like-for-like basis. What growth do I need to get? And then maybe you could refer to it in that way. Okay.
Janice is back in touch. She's obviously had a coffee. With recent focus on pension scams, should there be a ban on non-standard investments? The example that Janice uses is the colourful one of car parks in Dubai for a DB transfer scheme. Should we be looking at really constraining where people can ultimately take these things?
I think it's very difficult. I mean, again, pension scams, the government needs to take action, not just the regulator, but the government. And it's every time you close down one scam, you just see another one popping up somewhere else. Yeah. But we need to be thinking very carefully. I think these non-standard investments might come back when we have more on the FSCS and about perhaps risk-based levies. Yeah. And but the problem is if it's those who are scamming who are doing this, they won't be caught by any of these regulations. So very tricky, but anything we can do to give the population more clarity on that doesn't look quite right, and therefore they'll be wary of is another good measure that we can take in these more unusual investments. Yeah. We could do more to highlight, think twice before transferring into some of these unusual investments.
Yeah, I think we're back to Ken Davies' points there around the importance of the senior managers regime and really getting rid of the reckless and the criminal as swiftly as we can, really. I've got another question here from Dennis Tam, who wants to know, is it fair or reasonable for pension administrators not to give all the information up front? He seems to have an issue whereby you can get partial information, but the clock is now ticking on the transfer, and subsequent answers eating up 3-month guarantee periods. Essentially, I think his question is about, shouldn't there be a standard format and a standard set of processes that all the manufacturers out there are really forced to follow?
I think that'd make everyone's life supremely easier. But
is it feasible though, Steve, do you think? Is that?
Yeah, I think that it's a bit like the pension dashboard. There are some defined benefit schemes out there which are very well run and will be geared up to provide, or which could gear themselves up to provide extensive information in a standardised format, ideally digitally. A touch of a button would be great, but but there are others which might still be relying on paper, and they're the ones where we need more help to sort of find out what the benefits are within those schemes. These are the schemes that those who use dashboards in future will get the greatest benefit from finding out what they've got and how much it's worth, but they're the ones which will struggle to get there. But we've got to start somewhere. Yeah, we should have a standard template with all of the information in there, and we should be looking to get every scheme out there to use that template.
Okay. So back to those crystal balls then. When do you think these new rules are going to be introduced? And more importantly, what should advisors be doing in the interim? Can you take into account potential FCA thinking in the meantime?
We already suggest that our compliance and policy teams think this consultation is going to come in largely unchanged, and we recommend that you take on board these suggestions now as far as you can, of course. So that's certainly what we say.
Okay. You agree with that?
Yeah, absolutely. I mean, there's quite a bit in the consultation paper that is helpful to advisors. They've given indication of what they're expecting to see. They've listed elements, that it's not limited to those, but things like income and outgoings, bringing in other assets. So certainly cash flow is going to be playing a part. So things like that can be brought in straight away and should be. So there's a fairly good indication, despite being a consultation paper. I think there's quite a good indication of which way things are going.
Okay. Gentlemen, thank you very much indeed. Hey, if this sort of thing floats your boat, then we are back again, I believe, on the 27th of November for an end-of-year special. There's all manner of delights lined up for that advice show. I'll be back for part of it to guide you through the investment markets and all manner of other aspects around the advisory landscape as a whole. I'm off to go and have a nice mud bath and calm down after this eventful morning and afternoon of broadcasting. Hey, it's been a pleasure. Thank you for sticking with us. Thank you for those of you who put the questions in. It really is your show, and it does make it all the better when I can stump these guys with some questions that you like to throw into the mix. As ever, it's been emotional. We'll see you soon. Thank you very much.